$20,000 sitting in your account doesn't make you rich, but it does put a target on your back that most people don't see coming. Look, if you're grinding to save your first 20 grand, juggling rent, debt payments, maybe trying to build some kind of cushion so one bad month doesn't wreck you, you're probably thinking the hard part is just getting there. And yeah, that part's brutal. But here's what nobody tells you. The moment you cross that threshold, the game changes. Not in some motivational poster way. I mean, the actual rules shift. By the end of this, you'll understand exactly why $20,000 is a turning point, what silent costs start creeping in that can drain it faster than you built it, and the specific moves that help you actually keep it instead of watching it disappear. With inflation still eating into paychecks and emergency costs hitting harder than ever, getting to 20 grand feels like finally catching a breath. But if you don't know what happens next, that safety net can shrink before you even realize what's happening. So what actually changes at $20,000? It's not just a nice round number. It's where banks, the IRS, and even your own spending psychology start treating your money differently. First, let's talk about interest. When you've got a few $100 in a checking account, earning 0.01% interest doesn't even register. You're not thinking about it. But once you hit 20 grand, that same account is actively costing you money. Inflation's running somewhere around 3 to 4% most years. Your money in a low-interest account is losing hundreds of dollars in purchasing power annually, just sitting there. A regular savings account might give you 0.5% if you're lucky. On $20,000, that's $100 a year. Meanwhile, inflation's shaving off $600–700 in real value. You're not standing still, you're sliding backward. The second thing that changes is visibility. The federal government requires banks to report interest income over $10. Seems harmless, right? But once you're earning actual interest or moving money around, you're generating tax paperwork. If you decide to move that 20 grand into a high-yield savings account earning 4 or 5%, you're suddenly making $800 to $1,000 in interest. That's taxable income. It's not huge, but it's real, and it's something you didn't have to think about before. Then there's the cash transaction report threshold. If you ever need to deposit or withdraw more than $10,000 in cash, your bank files a report with the Treasury. It's not illegal, you're not doing anything wrong, but it does create a paper trail that didn't exist when you were working with smaller amounts. Most people never deal with that much cash anyway, but if you do, selling a car, getting paid for freelance work, whatever, you need to know it's tracked. You start thinking of that $20,000 as extra. That's the psychological shift that wrecks people. You worked hard to save it. Maybe you finally paid off a credit card or got a decent tax refund or just grinded for 2 years. Now it's there, and suddenly every expense feels a little more affordable. Car needs new tires? You've got it. Friend's wedding in another state? No problem. That thing you've been wanting for months? Why not? None of those are bad decisions on their own, but 20 grand can evaporate in 6 months if you're not intentional. And here's the painful part. Once it's gone, getting it back takes just as long as it did the first time, maybe longer, because now you've gotten used to spending a little more freely. Having $20,000 doesn't mean you stop spending. It means you start choosing what the money is actually for, because this is where the fork in the road happens. You can let it sit and slowly lose value. You can spend it down because it feels good to finally have some breathing room, or you can put it to work in a way that actually protects it. High-yield savings accounts are the most obvious move, and honestly, they're underused. As of right now, you can find accounts paying 4 to 5% with 0 fees and no minimums. On $20,000, that's $800 to $1,000 a year. It's not life-changing, but it's also not nothing. And more importantly, it keeps pace with inflation instead of falling behind. But here's the catch. Those rates don't last forever. When the Fed eventually cuts rates, those 5% accounts drop to 3, then 2. So if you're going to use one, use it now while the rates are decent. Then there's the emergency fund question. Financial advice always says 3 to 6 months of expenses. If your rent's $1,500, bills are another $500, food and gas may be $600, you're looking at $2,600 a month. 6 months of that is over 15 grand. So if you've got 20, you're just barely covered. That's not extra money, that's survival money. And that's the thing people miss. $20,000 sounds like a lot until you break it down. It's not "I'm set" money. It's "I can handle one bad thing without spiraling" money. Medical bill, car totaled, layoff, pick one. That's what it covers. Let's go back to taxes for a second, because this trips people up. If you're earning interest, that's income. If you decide to invest some of that 20 grand and make gains, that's income. If you pull money out of an investment before you're supposed to, there might be penalties. None of this is meant to scare you. It's just the reality that once you have money, the system starts paying attention. And if you don't understand the rules, you can get hit with surprises. A surprise tax bill, a surprise penalty, a surprise fee you didn't know existed. The smarter play is to understand it up front. Keep your emergency fund liquid and accessible. If you're investing, know the tax treatment. If you're earning interest, expect to report it. It's not complicated, but it does require you to think one step ahead. Here's the other thing that changes. Opportunity cost becomes real. When you had $2,000 saved, there wasn't much you could do with it except keep it safe. But $20,000? That opens doors. You could pay off high-interest debt. If you're carrying a credit card balance at 22% interest, paying that off is a guaranteed 22% return. Nothing else comes close. You could max out a Roth IRA for the year. That's $7,000 that grows tax-free for decades. If you're 25, that money compounds into 6 figures by retirement. You could start a side business. Not saying you should, but 20 grand is enough to actually try something without betting your whole life. The point is, once you have options, every choice you make is also a choice not to do something else. Letting it sit in a checking account isn't neutral anymore. It's a decision that costs you. So why does everything change after $20,000? Because you're no longer just surviving. You're at the edge of actually building something. But that only happens if you treat it like the tool it is, not like a finish line. The money doesn't change who you are. It just makes the consequences of your decisions bigger, good or bad. You can protect it, grow it, or watch it disappear. The system doesn't care, but you should. Real security comes from understanding the rules, even when they're stacked against you. If this cleared things up, hit subscribe. There's more like this coming. And if you've got questions about what to do once you're actually sitting on some savings, drop a comment. I read them.